It's now time for Market Watch here on Beyond the Numbers. We'll go to the market to assess the Treasury bill rate, what is happening in the T-bill market, as well as the Ghana Stock Exchange. There's so much development, positive ones indeed, and we'll assess into implication with new announcement from the government opening the bond market. We'll be speaking with John Nani of ThinkCap Securities, as well as Grace Nomanyon to give us more insight from Data Bank Research for more analysis on this development. We go straight with Grace, who is joining us right now on Zoom. Grace, it's good to have you. How's the market been so far this week? From Monday, it's been interesting. You look at the stocks performances, it keeps getting interesting with announcement from the Composite capitalization reaching about 230 billion Ghana cedis. How is the market faring?
Yes, thank you, Winston. The market is still trading strongly. Investor activities are quite strong on the stocks that are listed on the exchange, and that has contributed to the impressive performance you rightly mentioned on the equity market. On the other market, which is the fixed income market, however, we currently see some quite muted activity as investors are looking out for whatever the reopening will present.
Interesting. Grace, I want to understand from you. At the moment, we're seeing some banks, or let's say stocks, releasing their financials. It appears some attributed the appreciation of the cedi last year as one of the leading cause of their profitability going down. How does that play on the stock market, especially with these narratives?
Right. So most of companies have their cost factors. I mean, some companies on the Ghana Stock Exchange have some cost factors in terms of FX for operations. So I think the cedi stability also supported a bit, but we can't put all the glory on the cedi appreciation. I mean, internally, these various companies did their best to contain costs and other activities that brought them this far in terms of the profitability we see on the market. So yes, cedi played a factor, the appreciation of the cedi played a factor, but it wasn't the solely factor for the numbers we currently see.
Now, Grace, bring us up to speed on how the Composite Index has actually rallied this particular month and this particular week. Is it still tilted towards financial stocks?
Yes, even as we speak now, most of the counters that gained today are from the financial counters. I mean, notwithstanding the fact that under the financial counters, we have insurance companies such as SICB and Enterprise Group Limited, both gained today as we speak now, and then the banking stocks also came in strongly. So majority of the gains I would appreciate, related to the massive or impressive performance of the financial sector. Also, MTN, we're obviously doing about 30% of the total market capitalization, has also contributed significantly to the performance of the Composite Index.
John, I want to understand from you, what are investors looking out for? Is it to just get quick returns, or they're looking at the long term?
Well, I think most investors right now are quite uncertain about a lot of things, and so a lot of investors are on the short end, although I mean there are a good percentage of investors are also going long on equities, but I think generally most investors are still looking out for what government is going to do in terms of bond issuance. Government just issued the issuance calendar for Q2. And so I believe a lot of investors are on the lookout for what products government has to offer. And so a lot of them are playing on the short term to kind of strategize towards what government is bringing. On the stock market also has seen a good number of action, but it is mostly a seller's market. And so a lot of investors are on the lookout also for stocks. However, it seems to appear that there are more bids than there are offers, and so there's still money out there that investors are looking for where to put them.
I'll come back to you on the fixed income space, but I want to take you back to the equity space, where if you look at what is happening between the US, Iran, and Israel, what you see is that most European stocks are down since Monday. But if you look at our stocks currently, the Composite index is up, the financials are also up. What is the unique story? What sort of hedging do we have? What sort of cushion have we built to make sure that even though European stocks are down, we still have our market still very alive and attracting new investors?
Well, the international news usually has a lag effect. I mean, on our local market, and so I believe that eventually we would also see the ripple effect of the whatever is happening out there in our market. And so I think what we need to do is build buffers against when that ripple effect comes, right? And so, I mean, for investors in the country here, the geopolitical turmoil, you see that on the world market, oil is going up. There's been some rally in minerals and other commodities as well. And so I think local investors should be on the lookout for, gold-backed investments, oil-backed investments. Those will help us cushion the blow when the rippling effect of geopolitical tension finally gets here.
Now, Grace, still on geopolitical tensions, there's big conversation around the safe haven assets, and a lot of investors are looking at moving some of their investments and their portfolios and assets into gold holdings. Do you think that is going to affect our market in the long run? I'll take it from Grace and I'll come to John.
Right. Isaac, yes, in the long run, we might have some ripple effects or the impact of this geopolitical tension on our local market, i.e. the fact that investors are moving towards safe haven assets such as oil-driven assets. And I mean, on our domestic markets, we currently see a lot of interest on the oil companies listed on the exchange, which is Gold and Total Energies. Investors will be looking out for where to safeguard their capital or where to improve their capital. So yes, in the long run, yes, but just like John rightly mentioned, our parts of the market have lag effects when it comes to impact of what is happening now in the Middle East. So yes, we expect some possible trickle impact of what is happening to affect our local market, but that's just in the long run.
John?
Yes, I think Grace has rightly said it, right? And like I treated earlier, we would have a lag effect. Our stocks or our equity right now are doing well. I think one of the major factors is because there is a lot of demand for the stocks. And so what is happening out there is not really affecting us, I should say, directly. And so I think the factors that drive the European markets or the New York Stock Exchange, for instance, are quite different from what drives our market or what is driving our market currently. Until the factors that are driving our markets kind of run out, which is mainly because there is a lot of liquidity in the markets, and investors are still actively looking for where to put money. I think we will still enjoy the ride up. For a long time, we have enjoyed interest rates, which is, T-bill rates on the high. And so as the T-bill rates are now in the single digits, which is quite unprecedented for a lot of investors in the country, I think we are still kind of looking at where we can find, 30% increases, 20% increases. And so I think, and the equity market is the best alternative for us right now. And so,
John, I want to get from you briefly before we go. You say equity market is the best. With the announcement, exactly, with the government announcement of re-entering the bond market, how is the market receiving this basically sentiment?
Well, I think a lot of investors are on the lookout to see what government brings out, right? The bonds, although government has issued an issuance calendar, government has only given a ballpark figure of the amount they are looking to raise. There is no news on indicative yield where government will try and issue at, right? But I think government is also, going by a certain playbook of looking to reduce borrowing costs, right? If you see what's happening on the T-bill market, it's kind of an indication that government would, if government had their way, they would borrow at very low rates, right? And so, and government being the borrower, and every borrower wants a lower borrowing rate. So yeah. I don't think investors are anticipating maybe government to come and borrow at a 20 or even perhaps a 15. I think a lot of investors are anticipating lending to government anywhere between 10 and 15. And so the stock market still provides, in this case, a better alternative, because this year alone, the composite index is up 56.6%. That's as of close of market yesterday. The financial index is up over 80%, right? And these are just 2 months into the year. And so I believe it is good for, investors who are in the money. And I believe a lot of investors are in the money this year.
Finally, from Grace, before we go, Grace, strong appetites from our investors for high yields and high interest. So John is saying that, well, he doesn't think that government can even come to the market to borrow at, let's say, 20%. How much will be too low for investors for you, from your end?
Well, I can't give a figure to it, but I think investors will be looking out for better opportunities than we currently have on the money markets and then the existing bonds. The existing bonds are doing somewhere on average 12%. So maybe investors, depending on how long the government is trying to issue, investors may want to be compensated for. The odds are that inflation is down 3.3%. So, risk factored inflation may not be an issue at this point. So investors may just want to be up like where exactly can I put my foot to be best. And I think he rightly mentioned that the stock market presents good opportunities at this point. So investors may want to compare the odds. What are the odds that if I invest in the equity market, I'll be better off? What are the odds if I keep to, tap into the issuance, I'll be better off? I think these are some things investors will be likely considering when they put in their best in terms of choosing what market to invest in.
Grace and John, thank you so much for joining us here on Beyond the Numbers. Time for big analysis, and Caleb Ziblim and Dr. Richmond Etuahine will join us after this short break, where we will be discussing the decision to reopen the bond market from the perspective of banks. Dr. Richmond Etuahine has done a lot of research on this. He will join us, and then also analyze the Ghana Amalgamated Trust, which was supposed to be a savior for banks during the crisis period. But his research shows that if we do not take time, this could end up engulfing all banks. After this short break, Dr. Richmond Etuahine will join us, and Caleb Ziblim.